If I had to guess, now I'm really stupid to say this, and I'm actually reluctant to say it, but I will say it. If I had to guess, by March, you'll see silver back at all-time highs. If I had to guess. Now, what do I know? But based upon what I see, the 30+% swing back today, boom, no, why aren't people freaking out when it goes back up 30%? Yeah, we'll get back up there, and I think it'll be buyer before March if I had to guess. And all that happened is that the metal went from weak speculative hands who were holding lots of leverage to the big money that says, thank you so much for that discount. By the way, I won't be standing for any margin. I'm just going to pay cash for it. And if you look, who covered almost 700 contracts at 5,000 ounces apiece at the very, very bottom? Oh, that's right. It was JP Morgan. How foolish of me to think otherwise. Do you get it? The big money is still in control, but they are showing you where this is going. Not ending the bull market, just kind of showing the big traders who's really in charge, and that is the big money, until things get to a point where it's no longer about the ability to control things on paper. It's more about really who's got the physical. But there has to be a transition to get there, and I think that's what we're seeing right now.
Andy Schectman says the recent silver crash was intentional. Prices were pushed down to force leverage traders to sell. While small traders panicked, big institutions like JP Morgan bought silver at the bottom. Right now, about 400 million ounces of silver contracts exist for March, but only 103 million ounces are actually available for delivery. Because of this shortage, Andy believes silver is now in strong hands, and he expects new all-time highs by March. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
The March silver contract is really shaping up to be really interesting. Right now, the March silver contract open interest, meaning contracts that could stand for delivery, is between 80 million and 81 million, right around 80,500,000 contracts open interest. Now, I suppose that kind of sounds abstract until I tell you that each contract is 5,000 ounces of silver. So that's over 400 million ounces of paper silver that is tied to the March contract. The first day that they can stand for delivery is the 27th of this month, so 2.5 weeks away. But if you compare that to what is actually sitting in the COMEX, the registered category as of yesterday is 103.5 million ounces registered, meaning ready for delivery metal is 1 out of every 4. Is that right? 1 out of every 4 ounces, 402 million ounces could stand for delivery, standing against 103.5 million ounces. Now, typically, most of these contracts will roll forward or cash settle, but if even 10% of the March open interest stands for delivery, that's 40 million ounces. If 20% stands, that's 80 million ounces. Suddenly you're looking at a massive chunk of the registered category, and the market has to react. So the bullish bet isn't that COMEX defaults. I think it's simpler. I think that it's the price of immediacy rises, backwardation, the spreads tighten, and the market has to pay up or pull metal out of the eligible category, which is the other side of COMEX, which right now has 294 million ounces. The CME group raised margins to all-time highs. Raising margins is, first of all, people think it's very bearish. In my mind, it's not bearish. It's the exchange telling you that this move is real and it's getting violent. It's bearish at first because the amount of money needed to hedge positions increases exponentially. They've raised it twice right around Christmas, a few days before and the day after. It was like $18,000 to hedge 5,000 ounces of silver right around Christmas time. The day after, it went to 27,000 ounces, and now we're above $53,000, $54,000, $55,000 to hedge 5,000 ounces for a company like ours that would normally have 2 million ounces of silver in the warehouse. becomes very expensive. You better have $50 million in your margin account, or you're not going to keep much in the way of hedged inventory of gold and silver. But this is also true of speculators. And, the margins are a percentage of the contract's value. So when gold and silver go up, the contract gets bigger and the margin requirement goes up automatically. That's a new thing. It used to be a fixed rate. Now they're making it a percentage. So, the math does this as the price goes higher. Okay, that's fine, but they're also adding volatility into the equation. And when the market starts getting swinging, like we're seeing up 30, down 30, they can raise the percentage that you need on margin. And that's when it really bites. And because now you're getting squeezed from both sides, higher prices and higher margin rates. But here's why it's bullish. And to me, it's bullish because margin hikes don't stop physical demand. What they stop is paper leverage. And they force the weak hands out. And they reduce the ability to run giant positions just on thin collateral, where you can control massive positions by having a small margin account. And so, yes, you will get a paper flush when this is implemented, like we saw, and futures can and did drop when the leveraged traders are forced to liquidate. But that's not the end of the bull market. That's the shakeout. And the people that have been standing for delivery, as I've been really screaming about for quite some time now, for 15 straight months, so they're not using margin. And margin hikes don't end bull markets in metals. In my mind, they usually mark the point where the next leg higher becomes inevitable because now it's in strong hands and the price is now moving up. I want to give you a kind of what I mean by that too. So this is kind of one of the moments where the market confesses. And you had the biggest one-day drop in silver maybe ever. And everyone got emotional. People are screaming and panic and, they assume demand vanished. But this is how these idiots work, okay? The very next day, SLV takes in the largest one-day metal inflow in years. Dunnigan, that's not panic buying. That's institutional metal transferring at a discounted price. And what I mean by that is that you had 550 million shares outstanding the day before it dropped. The day after, it goes to 587 million. So that's a 36.3 million new shares that were created at roughly 0.905 ounces per share. That's about 33 million ounces of silver added in one day. And the authorized participants are the only one who can create those shares, and they can only do so by delivering physical metal first. So think about really what that means. Silver gets smashed, and immediately after the smash, tens of millions of ounces show up inside the ETF. This tells you that someone with a real balance sheet used the forced liquidation, this margin event, to source physical metal cheap and park it where they control it. And they control it inside of the ETFs. And this is metal migrating from forced sellers to the institutional vaults because these institutionals can do what's called share redemption, and they can redeem their shares if you're an authorized participant in metal, and it's far more opaque than it is transparent. And it's just another mechanism they have to drain physical metal out of the ecosystem. But when you line up the delivery pressure that we're seeing, the tightness in the registered inventories, which I want to talk about in a moment, all of this stuff, including what's going on in the ETFs, this is not normal flow. That's inventory reshuffling under what I think is major stress. And, Richard Russell used to say something like this to me. He used to say that markets don't reveal themselves during the violence. They only reveal themselves after. And where price is the weapon, freaks everyone out, but the inventory is the confession. The confession is we really don't have it, but we need to freak everyone out by flushing them out with price and margin increases. But nothing has changed. In fact, now you get into this Project Vault that's come up where, you got the U.S. government that is acting very much like silver is not plentiful. It's acting like it's strategic. Of course, they call it a strategic metal right now. We've had 6 straight years of a deficit, of course. It's been added to the critical mineral list, but now you got this Project Vault, a brand new U.S. critical mineral reserve. It's obvious that they're worried about disruptions, and they call it a public-private structure designed to stockpile essential raw materials inside the United States to protect supply chains. That means they want to incentivize domestic mining also. So you put a floor under the price. And then you zoom out, you look at COMEX registered as the delivery pile, which is massively lower than a few years ago, and the LBMA is being bled dry. Demand is rising, supply is constrained, and the world is treating silver like it's a strategic input. They're admitting this right now. And so I think that, when governments start stockpiling, the message is simple. The scramble for the real stuff has begun. And if that's really what they're going to do, you better clean up your balance sheets if you're wickedly short. Maybe that's what this was about. But I can tell you that nothing changed. There are no fundamentals that changed at all. In fact, maybe they're even getting stronger. But I do think that is exactly what is happening, is that you will see a world that embraces gold as a settlement vehicle. And at some point, real price will matter. And if you're trying to accumulate it, you just play the game of the West. Go ahead, be stupid enough to knock it down. We'll stand for delivery. And if you're not going to deliver to us, we'll incentivize you through massive arbitrage by having a price that is much higher than it is in the West. So you'll think twice when you can deliver me 50 million ounces of silver at a huge vig and then go buy yourself, a couple of yachts and live in Tahiti forever, because that arbitrage is significant and it's unrelenting. They're not letting it go away. Normally, arbitrage is settled when the business will flow to the arbitrage and it'll balance out. But they're leaving it there. They're taking all of their dollars that they're choking on and saying, fine, we'll still keep the price higher here for delivery in Shanghai. And people say, well, there's this tax that's involved. They don't know what the hell they're talking about. It's not true. The tax is eaten by the Chinese. The tax, when it is delivered onto the Shanghai Metals Exchange, there is no tax. It is when it is taken off the Shanghai Exchange, where there is this excise tax, or they're talking about this import tax, or whatever, the VAT tax that everyone says, well, you add the VAT tax into the metal price. Well, there's not that much of an arbitrage. Not true. When the dummies in the West buy paper and deliver the physical there, that tax is paid by the recipient of the metal when he pulls it off of the said exchange. So it's happening, to your point, Dunnigan, and the West is being exploited for their stupidity. For playing these games, and they have been for a long time, and you and I have been talking about that since 2020 to one degree or another, and now it's kind of getting to the end game. So if there are still some players offside that the West doesn't want offside, well, an event like we saw, a 50% retracement or 45% retracement in a couple of days, as contrived and disgusting as it is, it's already come back 30%. Still a long way to go, but it was done for these reasons. And when that happens, the players around the world say, "Hey, thanks. We'll stand for delivery on some more." And watch what happens on the March delivery. You're already seeing big volume on the February delivery. So, and March is a primary delivery month. So I expect some fireworks leading up to March, and that's why I think we have a chance to see much higher prices into March.